morning, everyone. We're here today for our reset portion of our video series, and we're here with Teresa and myself and Teresa Pedigo from TA Pedigo Services, and today's topic is banking. So take it away, Teresa.
Hi, well, good morning to everyone. Thank you for those who are joining us live and those who will watch the replay later. Just want to remind you that, let's see, this is, we're on session 6, I believe,
Yeah.
6, right? So we do have 5 that are recorded out there, and you can find it on the Sivia Law YouTube channel, correct? So if you missed something, you want to go back and see it or look at it again to learn some more stuff, please, we invite you to go back and check that out. But today we are very lucky to have Matt Warren, who is the Vice President of Commercial Banking with Carrollton Bank at the Edwardsville location. Hello, Matt.
Good morning.
Good morning. We thought it'd be a great idea to put a commercial and lender in front of all of you and talk about just business banking in general, but also about the importance of building a relationship with your banker. And we found, that there was some fallout on that first round of the PPP because people did not have good relationships with specifically bankers, and we're going to hit really the community bankers because that's where it's, I think, most important. So let me tell you a little bit about Matt more before I turn it over to him. As I said, he's the Vice President of Commercial Banking at Carrollton Bank at their Edwardsville location. Matt has been in commercial banking since 2006 with a great emphasis on credit analysis and underwriting. For the past 4 years, Matt has managed commercial banking relationships in the Metro East and St. Louis markets. Matt's focus has been on small to medium-sized businesses across multiple industries, including construction, medical, insurance, retail, and commercial real estate. Matt received his BS in Business Administration as well as his MBA from SIU Edwardsville. He is on the board of directors and serves as a treasurer for Call for Help Incorporated, located in East St. Louis, which again, I'm very grateful to be on the board with you. He's awesome as our treasurer. He's also a member of the Land of Goshen Rotary, Home Builders and Remodelers Association, and a member of the Leadership Development Council of the Southern Illinois Builders Association. Matt resides in Glen Carbon with his beautiful wife and 3 fantastic children. So take it away, Matt, and tell us some things that the business owners that are with us today need to know about the relationship banking. And I'm going to turn my camera off and leave it all to you.
Perfect. Yeah. So really, we're right now we're coming on the second round of the PPP loans, and I think I've heard from a lot of people, and I know in the media as well. You're talking about really how some of the bigger banks or people who were banking with the bigger banks, and not to name out any names, just really weren't getting kind of a fair shot, so to speak, and that's just kind of unfortunately how some of those banks are structured. Being so big and being a top 10 bank in the country, it's hard to process hundreds of thousands, if not millions, of applications, and you're running your own business here in Edwardsville or Glen Carbon or Belleville or Shiloh or O'Fallon or even in St. Louis, and it's really different. Those banks have a different model, retail focus, and so when you run a business, it's fairly difficult to establish some sort of relationship with that bank. You can have relationships with the bankers and stuff, but really when it comes down to running a business, and you're coming in for your first loan request or second loan request, my experience has been it's always a lot easier at a community bank because you're not just a number, so to speak. You're probably serve on the same boards, or you go to church, or your kids go to school together, with these bankers who are community bankers. So I think what a lot of businesses found is, specifically on this PPP round, the first and second round, is they really don't have a relationship with a banker. They don't have someone that they can call, when they don't have the answers, and they need the answers, and they're really just kind of lost in the dark. So I think a lot of people have kind of changed their mindset of, hey, maybe now's a good time to start looking at banks. And I, for one, would say, a community bank would be a great place to start. And, some of the, reasons, as I, previously mentioned, is, these are people in your community. A lot of times they get small business, and you're not just a set of financials in front of them or a credit score. One of the biggest things when it comes to banking is character. And so, so a lot of banks will look at the character of the person, how long they've been in business, and just if they establish a good rapport with that person. So, that's really where I think a lot of people are going to. Is I think this will be great for community banking. And some of the things I would say for the business owners is to start establishing a relationship with a community bank, and specifically a banker. Depending upon what your industry is, some banks fare better at other industries than others. And so I would suggest one of the first things that business owners could do is start networking and try to figure out who a good banker is, or a good bank for that matter, for their business. Talk to your competitors, talk to your family, talk to friends, talk to employees. A lot of people will know who the bankers are in the area, and who's good, who's responsive. Because I think luckily, in the Metro East, we're heavily banked, which is good. So it gives you a lot of options for banks. And so not only can you focus on the bank, but most banks have multiple bankers, and some people just gel better with other bankers than others. Just maybe age or demographics, or where they go to church, or where they go to school, or where they live, or so I think it's best to go out, start networking, kind of figure out who the banker is in your area that you want to do business with, and start networking. It's kind of a really weird time to go out and look for bankers, but I think most banks and bankers are aware of the situation we're in. It's a lot of it is not something that we can control. It's out of our control. So a lot of businesses will be seeing losses, or revenues are going to be off really bad, expenses are going to be off. And so I think a good bank or a good banker can probably see through that noise and really help kind of get your business to that next level, to that next step after all this is over. And I think that's one of the many things. I think that's a good kind of place to start, is to start networking and to try to find a bank or a banker. And like I said, I think a good community bank would be a great place to start.
So what can you say to, there were some that were scurrying, obviously during the PPP application process, and they were getting slower treatment from, again, the big banks that shall remain nameless.
Yeah.
But then some of them were like, will a lender take me if I don't have a relationship there? So I think that goes to your point. Now's the time, right? Because that you're gonna naturally, when I spoke to some business owners in St. Jacob a couple weeks ago, and they were a little bit aggravated, but they were working, again, not necessarily with community banks. And then they're like, well, then I try to go here, but they don't want me, because they're working with their own customers, and you're trying to give them first-rate service, right? And get them in the pipeline. So there again, that relationship, I mean, everybody can understand you're taking care of the people that have been your clients, customers for a long time, and have deposit relationships, with your bank.
Yeah. Yeah, and I think, just being in the process, and we, our bank did a sizable amount of the PPP loans, as well as I know our other banks did as well. Um, it was much easier for current customers. I mean, because we were, this was funding or guarantees coming from the SBA or the Treasury. But at the end of the day, we still had some due diligence that we had to do as a bank. We have CIP requirements, we have Bank Secrecy Act requirements, and that's really getting all the details on the business. So for our business customers, we already had that, so it was easier. Because our bank processed thousands of these, and there's smaller banks that processed thousands of these, and it's just really astonishing just how many banks and community banks have processed these. And yeah, it was easier for current customers. And when you're talking a bank like ours that we process hundreds of loans a year, and we process a couple thousand in 2 weeks, it's just, there's only so much bandwidth banks can handle. Luckily for us, we're in a position where, from a funding and a process and procedure standpoint, we could take on quite a few. But there are some banks that they just couldn't. They didn't have the work power. They didn't have the workforce to do it, and everyone's working from home. So it's a kind of a perfect storm, and really just kind of exacerbated some issues that most businesses experience over a few years. It's hard to when everyone's rushing and to get stuff done, and then banks like us, we're trying to figure out what we're doing because the rules were changing on us often, and we were going with kind of a playbook that was halfway filled out, and we just had to figure out everything else. So so I think a lot of folks realized how frustrating it was when they didn't have that one-on-one connection with a banker, or just had someone they could directly reach out to. And so I think that was kind of enlightening for some people. I know that some of the people that we developed relationships in this process are so excited to be working with someone, and that they can call on the cell phone or text or email and get a response back. Whereas before they were just a case file at another bank. And so I think this is it's enlightening for a lot of people, when it comes to developing that that banking relationship.
Absolutely. I was with kind of, and I would say not angry, but concerned or upset. Why did this happen? And I said, well, it's kind of different as those rules were changing, and I know you were watching them in the 11th hour. I don't know how much sleep you got between having the new baby, and watching it, but Matt and I know from working at larger banks, it's got to come. You got to have a message go up here, and then it's got to come down to the commercial lender. So some of them were saying, well, I've talked and I've got my application in, and these other ones are saying, well, they're saying that stuff isn't finalized yet. Well, they were telling the truth as far as they knew, right? The information was not flowing. So I kind of wanted to add in and dispel that myth that it depends on the banking structure and how large you are, how fast that information got down to the commercial lenders. But I really commend, I think the stories keep going on. Banks who are not typically SBA participating lenders got this down and did it a lot easier, a lot quicker, and a lot more efficient than ones who are participating lenders. And my own theory and thoughts expressed by Teresa Pedigo are not necessarily those that are shared with the world at large, but it was hard to detach your head if you were an SBA lender to, here's how I have underwritten SBA loans for a long time. Now this is different, this made it easier and less cumbersome, on a lot of the underwriting. And I think that was a hard mindset to switch.
Yeah, I think so. Because when you think of SBA loan, you typically think of red tape and You have to provide every information, that you possibly can. There's a lot of forms to fill out. The underwriting has specific requirements, and this was kind of a program that was issued by the Treasury, so to speak, with the help of the SBA. So it was the rules and of how it was to be, the monies were to be dealt out was kind of from the Treasury via the SBA. And so, initially when we thought this was going to be rolling out a lot quicker, and then they ended up having some additional clarifications and some, process procedures that we had to abide by. And so when, most of the lenders that were doing SBA loans traditionally, yeah, I think it was, kind of a change in your mindset of how you traditionally do an SBA loan. But I mean, the goal of the program was to get money out into businesses in the community as fast as possible. And it would be impossible if you had to follow all the traditional rules of an SBA loan. I mean, you're talking, weeks, if not months, and they were trying to get it out in days. And I think as the information came in, banks don't like to operate in gray, specifically when it comes to working with the Treasury and SBA, because the SBA comes in and guarantees these loans. So all the banks were trying to make sure they did it right, but also at the same time get it out fast to the economy, fast to their customers, fast to non-customers. But we're a heavily regulated industry, so we don't want to stub our toe specifically on a federal program. So I think everyone was trying to do our best, and I talked to a lot of bankers that I'm friends with at other banks, and just the amount of loans that these folks did and the amount of time, and just we had people here I know working, we had departments working 24/7.
Wow.
Which that's not the banker's hours I'm aware of. So
not what you signed up for, right?
No, I didn't come out into banking out of college for that. So but I think that just shows the commitment of community banks and banks in general, just trying to help out. This is a crazy time. It's not even like 2008. 2008 was created from just severe issues in the mortgage industry and excessive leverage. And my opinion is most businesses are doing better now than they ever have, and I think most banks are doing better now than they ever have. And so for this to kind of happen is just really crazy. It's something you can't underwrite. It's definitely hard to plan for. I think in the future we'll plan for it. I think there'll be some things that banks and businesses can do to maybe better set themselves up. And again, I think going back to my initial comment is if you have that banking relationship at the get-go, I think that's a good step in the right direction if something like this were to happen again, because there's quite possible there could be the situation coming up with lockdowns and months from now. I mean, who knows? We're in banking, and we try to underwrite to get to certainty, and right now is not a very certain time. And so we're kind of working with everyone as much as we can. I think a lot of banks are too, which is very helpful. We're not specifically on PPP loans, but business loans or business customers. We're working with them, and I know all the other banks are too. I talk to other credit people and loan officers, and everyone has a really good mindset of just, hey, we've got to work with people. This is it's just crazy times. It's a lot of times it's nothing that the business owner did of why they can't open. So it's in everyone's best interest, to work with that business. So that's kind of where we're at now, just trying to figure out what the next step is. But I think, there's some, like you mentioned, there's some things that you can do now to prepare for that next step.
Yeah, absolutely. What's the one thing that I know that my clients and prospects and everything have talked to? If you don't have a line of credit, you should have one, because not just for this uncertainty of times that you may need it, for something, but just in general, we can always have, I guess I talk to clients about, with what we're in, there might be the slow paying coming in. So they're not collecting on their accounts receivable, and so their cash position, is going down, and having that line, that they can draw on is very important. So when you're out there looking, for your relationship and building that, that's something else definitely to think about. And I know Todd was helping, his clients and other people the same way as I was to get them directed, to good lenders and good banks. And it was so awesome to hear the phone calls back, of the people that were, thank you. We didn't understand it. We weren't sure that we, needed it, whether we should do it. But and I'm speaking for Todd, but Todd, I can stop talking here, and you can I do have more questions for Matt, but well, just like I said, just the excitement of hearing them that they got it, and they breathed a sigh of relief. So I'm thankful to all the lenders that helped make that possible, and also made us look good. So Todd?
Hey, Matt. I've got a question generally is how much lending is actually going on outside of PPP and some of these other issues right now? Are you seeing a lot of lending generally, or do you see kind of a slowdown on credit?
Yeah. Anecdotally, I would say across the board, it's slower, but there's still quite a bit going on. If you look where, loan rates are right now, our mortgage department this year, since has just been absolutely just slammed, just crazy busy. And I would say that's true for every mortgage company, because you're talking about 30-year mortgage rates at one point in time, and these were floating, seemed like every hour they were changing there for a little bit, but you're talking 30-year rates in the low threes. So from a mortgage standpoint, from refinances, we're still seeing a lot of purchases in the residential market, and even on the commercial side, most banks will price on the yield curve, and as you see the treasuries are historically low. It's historically flat too, even long out to the 10-year. So we're seeing a lot of commercial real estate. We're seeing some refinances. We're seeing some opportunistic purchases coming in, because I think, as I mentioned before, coming into this, some companies and individuals and investors were fairly well capitalized going into this. So I think a lot of them are seeing this as an opportunity to go in and buy a piece of real estate, or to refinance their current debt on their business, talk to competitors about possibly purchasing their business or expanding. So I would say it's the expansions and acquisitions are a little bit slower. I think everyone's starting to dip a toe in to see what it looks like. But I think there are some companies that weren't well capitalized. Really, even with the PPP loans, we're going to see some pain in the market across the country. I think it really. I was watching something the other day, and this kind of just sped up the process on a lot of companies of not being able to make it. Unfortunately, we see that often. There's some companies that just don't run well, and for whatever reason, they don't have a good business model, or it's just they haven't really been able to penetrate the market or sell or whatever it is. So I think this has really just kind of sped the process up, months, if not a couple of years. And so I think some businesses that have been in a business for a long time, 10, 20 years, and have seen these ups and downs and are well capitalized, I think are going to come out of this stronger, quite honestly, because I think they're in a position where maybe they were at a bigger bank or a different bank, and whether it was the PPP deal or some other factor, say, hey, we need to look at a different bank, and they'll maybe refinance, or they'll talk to their current bank and refinance. And
Mhm.
for commercial real estate investors, the biggest expense they have is their interest expense. So if they can lower that, that gives them more cash flow to be able to re-leverage and do more projects, buy more properties, or for the business owner, allows them to buy that other piece of equipment that they needed, or buy that other truck to hire that other crew. Because there are some businesses that are still busy, or if not busier than normal, and luckily we came out of a period where you couldn't hire anyone because the unemployment was so low, and now it's so high, and you can get really good qualified labor right now. Specifically, contractors talk about that all the time, and so I think those are still in high demand. I think that's tough, but people who are needing office workers, or whatever it was, they're able to actually get some labor force in, and it's not like pulling teeth to actually hire someone to fill a spot that you need.
Right. Not just a warm body. We can get a talented body.
Correct.
I've been reminding that, if people aren't working and they're sitting around and they're realizing, hey, this is pretty cool to spend more time with my family. I'm less stressed. So this is really leading me to think that I should do something else or work for somebody else. So
right.
Really encouraging them. And you came around a couple of times. I was going to ask you about refinancing. And, with the business owners right now getting hit with, again, all the SBA loan opportunities, and other grants or so forth that might, be available to them, that they don't think that if they already have a loan, about how much it can change with the refinance. I had one of my first clients, and it was a great example that they just didn't know that they could refinance. The loan was over 3 years in. So they had demonstrated, 3 years of repayment. They had a great business growing. They had all the numbers, and was struggling a little bit. And by just going in and refinancing, it pumped like an extra $15,000 in the cash flow right away,
right.
which can significantly make a difference, in a business. But you wouldn't know that unless you have a relationship with a banker that you can talk to.
Right. Yeah, and really, even just to tell you where the banking in general is. If you would have done a loan, this time last year, if not first quarter of 2019, a good rate at that point in time would have been, say 5.5, 5.75, 5.25, depending upon where you're at. Now you're a whole 1% less, or even lower, depending upon where you're at. And if you think about that, if you $1 million, that's a significant amount of money. That's a part-time employee from a refinancing opportunity. And that's what I'm telling you. Good businesses are always going to be in demand for banks. Companies that have been around for a long time, have run a really good business. They're organized. They have a good bookkeeper. They have a good relationship with their accountant. And quite honestly, they have good cash flow to support the levers that they take out. Very lowly leveraged, and those folks are going to be in demand all the time, and they can drive, specifically whenever banks are looking for loan customers and deposit customers. They have some power in the negotiation when it comes to rates and terms. And so a lot of companies don't realize that. So they've been at, a larger bank, and they've just had their line of credit, and, they say, hey, well, that's just, I think they would probably, I'm a good customer. I'm sure they're giving me the best rate that they can. A lot of times that's the case. A lot of times that's true. Sometimes it's not. Sometimes some customers, refinanced 2 years ago, and they think that's kind of where rates are. So unfortunately, I've seen people, really good customers, that were paying, almost 6% on stuff. And at the time, it wasn't a bad rate. If 18 months ago, it wasn't a terrible rate. But things have changed, and I would say, you know, we hate for customers to leave just for rate, because we are a relationship bank. But I mean, when you're talking a full percent, you know, there's it might be a good time to reevaluate that relationship. So, but I think most good banks and most good bankers are going to be very, you know, they're going to come at you with opening ears if you have an issue about the rate. I know, I always do. If, you know, we had people we did loans for last year, and they were high 5%, and this came about, and we were talking about doing some restructuring and some modifications to help them out. And yeah, I mean, we put them on interest only to help them out because they were non-essential business. They could not open, and we lowered the rate too. You know, it was the right thing to do. They were at rates where they were last year, and just to help them out, you know, they're paying interest only. We knocked off 125 basis points on the rate, and it's a fair rate for us, fair rate for them. It's just the timing when we did it last year was different. You know, just the rate cycle was different. Now it's a little bit lower, and so so they're getting the benefit of it, and it's just something for us to help them out a little bit. And we would do that for, you know, good customers who weren't, you know, struggling. You know, if there was, you know, we did a loan for somebody a year ago, and be like, yeah, that's, you know, the pricing needs to be, you know, adjusted if it's way off. If it's way off. Again, you know, we haven't seen the treasury markets dip like this in years, so it's unprecedented that you'd see this type of dramatic rate fall.
Right.
And so it's real. I mean, you know, it took years to get rates back up. You know, it's taken weeks to have them just bottom. So.
Matt, with some of these regulations, you're hearing, you can forbear your mortgage, you can forbear, you know, or basically stop paying your mortgages, or stop paying this or stop paying that. Do you have any comments with regards to whether you should or shouldn't do that?
Yeah, so for on the consumer side, I know Fannie Mae and Freddie Mac and a lot of them have allowed that. I know as a bank, we're working with customers to forbear payments, to defer interest, and work with folks. I mean, if it is a absolute necessity, I would say, you know, from your personal standpoint, I'd say, yeah, that's something you should probably look at. From a commercial side, on the commercial real estate, you know, obviously Fannie Mae, and it's not regulated, you know, because those loans typically are held on the bank's book, so it's the bank's decision. You know, we're with customers. I mean, we're putting a lot of customers on interest only, specifically for business customers and for commercial real estate customers. I was talking to a gentleman yesterday. He's got a lot of rental properties, and up until 3 weeks ago, everyone was paying their rent just on time. And last, you know, for the month of May, he said half of my people are not paying me rent. So, you know, that's obviously, you know, good customers. And, you know, obviously as a real estate investor or business customer, whenever your revenue falls by half or more, or, you know, you can't even open for business, it's you know, if you can go interest only, I would definitely suggest it. Or if you can arrange a deferment program. I know there was a lot of, you know, our bank in general doesn't do a lot of hotel lending, but I've heard through various other banks who have hotels, loans, and hotel customers that, I mean, their revenues essentially just dried up and went to nothing. And so they couldn't even afford the interest on their property. So a lot of banks were working them with to defer interest, to push it out, you know, put it to the end of the loan. And so luckily, you know, there's a lot of banking organizations, you know, RMA, Risk Management Association, American Bankers Association, Illinois Bankers Association, you know, they're really recommending everyone work with everyone and kind of giving some guidance of best practices of what everyone's doing in the industry, because it's just a crazy time, because it's, like I said, banks don't like to deal in the gray area. So we're trying to help as much as we can. So we'll see what this looks like, months from now. But we're hopeful once everything can kind of get back open, this will be kind of a blip in the map when it comes to, going interest only, and it just kind of adds a little bit of, time to your amortization. But at the end of the day, it works out for everyone, because the last thing most banks want to do is go after their collateral. That's usually the last resort that we want to go through. So we're working with everyone. I think a lot of banks in the industry are as well.
With regards to, I'm hearing word that the Fed may be starting to lend on its own to small to medium-sized businesses. Are you hearing anything further on that, or do you think
we heard a little bit about that. I actually got an email about that Sunday, talking about that program. It's not like a PPP loan where it would be possibly forgiven. The rates and terms were very attractive for customers. I did remember seeing there was like a 1% transaction fee from the Fed. Looking at the parameters of it, and at this point, we're not seeing where there'll be a whole lot of demand for it. I think there might be some demand for some bigger customers, bigger clients of the bank, and some of your larger manufacturers. I could see some demand there, because I think the overall capital markets, when you're talking to, about your middle market companies, the capital markets, I wouldn't say have dried up, but it's slower. And so I think that might be kind of an alternative source of capital. But again, we could see some smaller businesses, utilize it, but we're not seeing a ton of demand. But I think you'll start to see some more information about that and start to see that more in the market here the next few weeks.
With regards to what are some of the key factors with lending? You talked about character in the beginning, which is one of the factors. How do you measure that? But then secondly, is there anything from a financial perspective in your balance sheet, or when you look at tax statements, is there anything that you're looking for, from a banking perspective?
Yeah, so from a character standpoint, one of the things that we look at is, in banking, there is always the ability to pay your loans, as well as the willingness. So we have folks that, when times get tough, they might have the ability to make their payments, but the willingness isn't necessarily there. And we have the inverse of that as well, is that people who want to make their payments, but they can't. They don't have the refund, the resources to do so, or the cash flow, or the balance sheet liquidity to do that. Those are the people we want to do business with, because really character comes from, and the way that we kind of measure that is, we look at, how long these people have been in business, and we have a really good measuring stick of, what if this business has been around since, before 2008 and has survived all these ebb and flows, and we know, whenever 2008 happened, yeah, they had some tough times, but they made all their banks right, they made all their vendors right. That's really what we're looking at, and really whenever when we talk to people, when we're going out and meeting people and calling on people, you can generally get a good sense of just talking to them, their demeanor, of how they go about their business, how they treat their employees, how they treat their vendors. Is this person has good character. You can tell that, hey, this is someone I want to do business with, because if this goes bad, I feel like they're going to be communicative with me. They're going to let me know, hey, we've got an issue, and not hide it and not try to, not try to get one over on the bank. That's the one thing we're looking at, because at the end of the day, it's not the bank they're getting over. It's our depositors. It's all of our other business customers. It's all of our Jane and John Does who have their deposits here. That's really what it's looking at. Is we're being fiduciaries for our depositors, and so we really like to partner with people that we know through people that they work with. They have good character. That, hey, this is a person that, yeah, it got tough for them in 2008. They had a couple of bad months or a couple of bad years a few years ago, but everyone was paid whole and stuff like that. So it's really kind of a character. That's the most important thing, but it's the hardest to gauge. And I think it just comes with as being the longer you're a banker, I guess, the better the feel you got for it. It's just kind of a gut feel for people. And community banks can do that. It's hard to do that if you're a bigger bank. So that's why bigger banks, it's hard for them really to gauge character, because they don't have the one-on-one interactions like we get to have. So, and that's the most important thing. And then when it comes to kind of the quantitative information, that's more qualitative. When it comes to the quantitative information, when we're looking at customers, the number one factor is, does this business make enough money to pay us back? We have a lot of people that say, hey, I've got a lot of collateral, I've got a lot of equipment, but I haven't made money in the last 2 years. Well, that's tough for us. It just quite honestly is, because we have all commercial loans. Well, I shouldn't say all, but I'd say 95% of all commercial loans are structured as, we look at three things. We look at, the primary source of repayment, which is typically the cash flow that the business can generate. So in the simple measure is just to kind of eyeball something is your net income plus your depreciation and your interest. Those three factors added up, divided over your annual debt payments. So whatever that looks like over the year, and that ratio is called your debt service coverage ratio. That is the end all be all. I would say 90% of your deals, there's a debt service coverage ratio factor. We can go into, depending upon the business, there could be a fixed charge coverage ratio, there could be adjustments, but that is essentially the number one factor. So that's normally the primary source of repayment. The second is collateral. From that standpoint, is it equipment? Is it real estate? Is it accounts receivable, inventory? So we'll look at the quality of that, and it's a little bit different, specifically if you're talking about a line of credit, because a line of credit, you typically are looking at inventory and accounts receivable. And when I say quality of that, we'll look at, is your inventory, is it newer? Is it marketable? Is it turning? Are you actually able to turn your inventory? What's your accounts receivable look like? Is it stale? Is it all 120 days past due? Is it all current? So we have a lot of fancy things that we can do to figure out what your days receivable are, days inventory, and I mean, we can, if you're looking for a line of credit, you don't have one, we can do those calculations to figure out what that looks like. Or it was like, man, this is really, your inventory stale, you haven't liquidated it, is our first thing, as well as there is no one buying your product, is it damaged, is it injured? So a lot of times we'll look at that. And then the third is the tertiary source of repayments. We'll look at the owners, and that's usually our guarantors. So typically our owners or executive teams of the businesses will personally guarantee the business debt. We'll look at them, hey, do they have the liquidity to support the business if they have a couple bad years? Do they have what does their overall cash flow look like? Or do they have a bunch of other projects or other businesses that would drain from this business? So typically, and that's And that's something we'll go into more detail if it's a bigger project, or if it's if we have kind of a seasoned entrepreneur, and they have they're fairly well established personally, and they're starting something new, and they don't really have a business track record on this new business yet. Yeah, well, it's quite possible we would take a shot on that because that person is fairly strong, but we'd want to understand pretty fully what other stuff do they have out there that could hinder kind of our bank debt or kind of our risk on this customer, and really has nothing to do with us, but could be a risk for us. That's really what we do, is we try to manage risk. All those different factors is a different risk, and so we try to look at all the various risks that could happen as we make a loan.
Matt, a lot of times people will ask me, what is the most important ratio? I mean, we got a lot of ratios, again, that you look at, but what's, one of the most important when you're visiting the bank? And I say the debt service coverage ratio. Could you say that formula again so just everybody catches that this is the biggie. This is one you can calculate yourself.
Yeah, so the easiest way, and again, you can get fancy with it, but just the real quick glance ratio is you take your net income, and usually that's, if you're looking at a tax return, that's usually they're on the first page. Then you add back your depreciation as well as your interest, and that's actually, and you can do it before taxes too, because a lot of the companies we look at is S corporations, so so we typically don't count the taxes either. So that's actually the EBITDA. So EBITDA over your overall annual debt service, the required principal and interest payments that you're required to make. And again, that's the easy. Every business is a little bit different. Sometimes there's also a ratio called fixed charge, which is pretty similar, but we'll maybe add in the lease payment as well. So that's really what we look at. I would say 90% of the time we have a debt service coverage ratio is kind of the watermark of, can this business pay back their debt? And the one thing I will say about a line of credit, because I know you mentioned line of credit, is typically on most traditional lines of credit is we're not really looking at, well, we are, but we're looking at the cash flow, but we're also looking at the cash conversion cycle. Which that's a little bit harder to explain, but we're trying to see, because usually when you use a line of credit, you're using that to bridge the gap of cash flow. So you have cash, you turn it into inventory, you turn it into accounts receivable, and then you turn it back into cash. So that line of credit is, let's say if you have inventory that sits on your shelf for 20 days and it takes you 30 days to get paid, you've got 50 days of cash tied up in a product to get back. And that's where your profit is. That's where your margin is. That's where all your stuff is. So in that meantime, you've got payroll, you've got rent, you've got all this stuff. So the line of credit is then in place to bridge that gap. So bridge that 50 days or so to get that money back to cash while you have all this stuff in expense. And then when that money comes back into cash, you pay down your line of credit and you do it again. That's a very simplified way of looking at it. It's more complex because that's like you're only selling one widget. So but you're probably selling more than one widget, and so the cash conversion, and most good bankers will know and can speak to that, and can kind of walk you through the process of, hey, I need a $100,000 line of credit. Well, no, you could probably get by with 60. Or, hey, I need a $50,000 line of credit. No, you really need 75. And so there's a lot of tools that we can use to help on the line of credit, because again, lines of credit are used for the cash conversion cycle. Your traditional equipment, real estate, those get paid back by your cash flow.
Excellent.
Matt, on that same topic, it's common for accountants or owners of a company to say, I don't want to pay any taxes.
Yeah.
Or I want to reduce my taxes. Okay, so can you speak to that and versus lending?
Yeah, so that's a very that's kind of a tightrope that we have a lot of times, you know, because a lot of business owners, they try to structure themselves where they pay as little as possible on taxes. Now, you know, for us, you know, if the accountant is utilizing, say, Section 179 depreciation, which is basically when you purchase an asset and you write it off all in the first year, we can pick that up. We can pick that up. We add that back to the cash flow, because typically whenever you say, let's say you buy a truck or a bigger piece of equipment, you write it off on 1 year, you're probably going to buy that with debt anyway. You know, 9 times out of 10, you're going to put some sort of loan on it, so you're not depleting your cash reserves. Or if you have enough cash, so we'll add that back. The stickier part or the harder part to get is whenever you might start making some payments, specifically if you're on a you know, cash basis, and you make a lot of payments in December for services that won't be rendered in January, just to lower your tax basis. And what I tell a lot of customers is, you know, that's okay. I get it, but also at the same time, you know, you can't do that every year. And just expect to just operate at a loss, and you know, where it makes it very difficult for us to say, hey, this is a business that it makes money. But also the other thing is, you know, if the business owner and or the accountant can give us like, hey, here's kind of what we did to limit tax liability, and as long as it makes sense for us, and again, because as I mentioned, we're going to default to character. You know, a lot of the times that, you know, hey, this is pretty tight, you know, what happened this year? Did you lose a customer? Or hey, your margin's off a little bit, or your expenses, you know, kind of jumped up. You know, what happened here? And I think, you know, if the business owner and or the accountant can really speak to that and why it makes sense, you know, most banks, you know, or most community bankers who you have a one-on-one conversation with are going to understand that. But again, we deal with that all the time. You know, we have businesses that they hate to pay any taxes, and I get it, I understand. But you know, we've got to, you know, we tell some folks, it's like you've got to give us, you can't do that every year on so but it's like I said, if they do it with depreciation, or they're doing some sort of non-cash event, you know, we can pick up on it and we add it back. And so that's easier. It's whenever you're starting to add in expenses, and, you know, because one of the last things we want to see is expenses trending upwards, margins getting compressed. Unless it makes sense, you know, margins being compressed, but you're, you know, selling more is okay. But it's a tight, you know, kind of a tight area that we have to kind of walk. So
I know we're getting top.
That affects the loan. That affects the loan that you can give. I mean, you know, so the tighter the margins, the less profitable you are. You have the reverse of not getting a loan if you need lending.
Exactly. Yeah. So that's what we say. It's like, you know, you can get yourself, if you do that continually, in the story that you're telling the banker or what the accountant's telling us, if you're doing that continually, it might make you essentially unbankable. You know, it's something you have to, you know, figure out, you know, how comfortable are you, like, just because you don't want to pay taxes, you know, it makes it tough on banks. Again, we're assessing risk all the time. And if you're consistently showing losses or decreased margins and, you know, net losses, it's tough for banks. It's tough for banks. So, yeah, you've got to be very careful with that. Now, I will say going forward this year, you know, with what's going on, we're going to see a lot of businesses that were profitable before this, or will be profitable without this. So I think there's context, you know, to this year specifically, you know, so everyone knows the story. So of why, hey, last year we made $200,000. This year, we made nothing. We get that. I mean, we understand that. So, but when it comes to minimizing taxes every year and showing net losses, it's a little bit tougher.
I know we're a little bit past the top of the hour, but I have one more question kind of to summarize. And you have already talked about this a little bit, but we see people posted on Facebook. I've had calls on it about the forgiveness of the PPP loans, the criteria, what that looks like, what happens if the amount, is not all used. What about that 75-25%?
Yeah.
Are we there yet to know the answers for all of these yet?
I would say yes and no. I think overall we kind of know how it's going to work, but I mean, we're still awaiting more information. And literally, I was reading something, this morning from the ABA, and they were talking about how if you're wanting to hire back an employee, but they would not come back, you can still claim that. You can still work. That will still be taken into account for the forgiveness calculation. You just have to document it. You have to document that you offered them to come back, and they flatly denied, say, I'm not coming back. Because I know that's a situation. I have a couple customers who are concerned about that. They've got people who just, they're not coming back. And so they're still, even now, coming out with information on what that looks like. And I would imagine as quickly as this all came out on the application process, and we are still getting information to this day on the application, weeks later, it's going to be the same thing for the forgiveness. Luckily, we've got, a little bit more time on the forgiveness. So I would imagine, overall, I think we've got a framework of how that's going to work, but the nuanced details of situations like that where you offered someone to come back and they won't come back, I think those criteria and how we are, as bankers are supposed to look at that coming up, I think that's going to be released, kind of weekly, probably for the next 8 weeks.
Wow.
To be quite honestly. So I think we don't have the specific process yet from the SBA or from the Treasury, but our understanding of the way it works is when you go to apply for the forgiveness, it's after the 8 weeks, and then you just apply to the bank or the banker who made you the PPP loan. We have no forms yet. But what I tell people is, what you're planning to use that money on, payroll or utilities or rents, just start keeping detailed records of what you paid it on. For some people that have, payroll software like ADP or Workday or whatever it is, that's a little bit easier. Because they can just pull those payroll reports and the 941s, and we'll be able to calculate that. Some of the smaller businesses that don't have quite as much detailed record keeping, and just keep the payments, of what you did on payroll. Just keep track of that. Keep track of, get copies of the checks that you wrote for rent. Keep the checks that you wrote for utilities and the bills that went with them, because your window for the forgiveness starts the day one that you close that loan, and it's the 8 weeks thereafter. So just, the time you need to start, keeping track of it. Luckily on the, I would say more information is better than not enough.
Yeah.
So that's the kind of process. So that'll be kind of rolling out. I think, like I said, I think every week we're going to hear more information on forgiveness, because I'm getting the question all the time, and I'm just, my advice to everyone is just keep detailed records of your payroll, rent, interest on your debt. Just keep good records of that. Put a little file in your computer or folder and just start putting that in there. That way you've got it saved, or put a file in your in your desk with all that information, so that it's there. And what I'm telling my customers specifically on the PPP is when we have concrete information what the process looks like, I'm going to keep them updated. of what that looks like, so we're all on the same page. Because I'd hate for one of my customers to be kind of left in the dark and miss the window of, the forgiveness. But luckily, the way the programs work, I don't think anyone's going to go on without calling me of getting the information. So.
I mean, you've given so much great information, and for all those who are watching live and replay, take what Matt's saying to heart. But the ones, like I said, that you're seeing things on Facebook, you're being bombarded and you're being worried as a business person about what that repayment or forgiveness is going to look like. Know that it's not all there. There's pieces of the puzzle that are there. They're not all there yet. So I always say, if you don't have enough to make a decision right now, if you don't know all your facts, you really can't make a decision. So don't make a decision not to get, upset or wiggy right now, and keep in contact with your lender that they got the PPP loan, and you'll be just fine.
Exactly. And if you got any questions or anything, feel free to reach out to your banker and say, hey, there's any updates, or is there anything I should be doing differently? I would think most bankers wouldn't have an issue kind of helping you out on that process. Because most bankers that I'm talking to and that I know that are the good bankers, they're doing that for the customers. I think, we have a lot of banks in this community, in this area, that are really concerned about businesses, and so we're trying to do everything we can possible to help. And sometimes that's just picking up the phone and letting them vent. So we've had a lot about the PPP process, about everything going on, and just trying to, sometimes we're kind of a sounding board. Sometimes it's on loan requests, sometimes it's on things they should do with their business. This season of life, it just seems like they're just trying to vent about what's going on at the government level, at the Fed level, not being able to open, about employees. So that's kind of what we're doing right now.
Awesome. Todd, I'll stop asking questions. Do you have anything else?
I don't think I've got anything else. Matt, I really appreciate you coming on today. And for all those who are listening, we've had so many questions between Teresa and I that unfortunately we weren't able to ask any of the questions from the audience. So, but if you have any questions, reach out to Matt, or reach out to the one of either Teresa or I, and we'll definitely pass those questions on and see if we can't get your answers. Again, appreciate you being here. Lots of great information, and we really appreciate it. Well, thank you very much, and I look forward to seeing you guys all again. Teresa, I'll see you tomorrow.
Thanks again, everybody. Thanks, Matt.
Thank you.